All right, 9:02, we're going to get started. So, hope everybody is having a fantastic day. It is 1 week from Christmas, right? So, we're a little over 1 week from Christmas. So, ultimately, when we look at the holidays ahead, it's the year in review, right? We're going to be talking about everything that occurred in 2022 and also looking ahead for the future. So, I know that the market has been a roller coaster this year, to say the least. And I know it's very important to all of you because, like I said, we're 1 week from Christmas. And instead of thinking about presents and candy and cookies, you guys are going to be sitting here and listening to market talk, right? So, with that, we'll get started. So, I always start with an agenda. We're going to cover 4 key items today. We're going to talk about what's going on in the market, where we are right now, and how we got here. We're going to take some time to look ahead and say, what are we anticipating for the first quarter of next year and throughout 2023? And then there's some nice key opportunities there as well. Okay. And we're going to spend quite a bit of time going over what some of those opportunities are. Before I get started into the actual presentation, I want to remind everybody this is a webinar. So this is live. If you have questions, on the bottom of your screen, there's a Q&A tab. So you can click that Q&A tab. You can ask any question that's out there. So Jenna is on the meeting as well. She'll be facilitating those questions, and she can message myself right away, and we can get those answered for you. So I do encourage that if you have a question when we go through something, please ask it. Also, in addition to that, at the end of each one of our main or key points, I have key takeaways listed. So those of you that are taking notes, I'm going to go through the meaning of some of these concepts. And then the next slide, I will have key takeaways. So things that you need to be aware of that if you're taking notes, you should jot down. So those of you that don't know me, my name is Tyler Braun. I'm the Director of Financial Planning with the Tranel Financial Group. I've been with the firm for over 15 years. I'm also the co-author of 8 Things I Wish I Knew Before I Retired. And I've worked with hundreds of clients through the process of retirement and help manage and oversee our advising team. So with that being said, we're going to get started here. So with change and volatility comes opportunity. Okay. And that's the theme for today, right? There's been a lot of change this year, right? 2022 feels like it's been 10 years wrapped into one. If you think of all the change that has occurred through 2022, all of the different things that have happened, most clients that I'm talking to, they're pretty darn tired, right? Now, it's also been a great year, but it's been a very volatile year, right? So remember, with that volatility comes opportunity, and we're going to talk about some of those opportunities and how you guys can benefit from those going forward. So let's take a look at where we're at right now, right? The S&P 500, as you can see on the screen, year to date is down about 18.78%. Okay, so from where we started at the beginning of the year in the S&P to where we are as of business close yesterday, right, is down 18.78%. And if you look at this, this is literally the definition of a roller coaster, right? We started out the beginning of the year close to our all-time high in the markets, right? And you would hear about, inflation getting higher, right? And I remember there was a term in the first quarter that many of you might recall where the Federal Reserve called it transient, right? They thought inflation would be transient, which is a fancy word for temporary. They thought inflation would spike quickly and ultimately start to come down very quickly. So we started to see the markets decline slightly in the first quarter. They actually started rising slightly at the end of the first quarter when interest rates started to go up. And the reason they started to react positively is because they thought inflation would taper much quicker than it has. We got to the middle of the second quarter, beginning of the second quarter, and Russia and Ukraine started to come into conflict. And ultimately, we saw gas prices shoot through the roof. We saw a lot of geopolitical issues come to the forefront, and the market really took a nosedive in the second quarter, dipping very, very quickly. All right, we're going to talk about some of that. Now, we started to see the market recover at the beginning of the third quarter as the market was anticipating that interest rates would start to slow on that increase. Okay, we're going to talk about what that means and why they've continued to increase them. And starting in the middle of the third quarter, Fed Chairman Powell came out and said, no, we're going to put the pedal to the metal and we're going to continue to increase interest rates at the fastest pace in U.S. history. And as they did that, the market dipped. And at one point, the S&P was down 27% from where we started at the beginning of the year. So the last month and a half, we've had a bit of a recovery. The market's up close to 10% the last month and a half. But you notice we're starting to see those ups and downs and that volatility continue. And we're anticipating that for the short term. So with that being said, that's where we're at right now, right? From where we started the beginning of the year to where we are right now, the market's down approximately 18.78%. All right, so what's going on? Right, there's three key pieces that we have to pay attention to that we're going to dissect. Okay, the first one is inflation, right? And you notice I put still on there, right? I feel like I'm stuck on repeat here when I'm talking with clients because it's inflation, inflation, inflation. It's what you hear in the news all the time. We're going to break down what inflation is, why it got so high, and what it looks like ahead. Interest rates have continued to increase. Okay, so interest rates have continued to rise, and that's to curb inflation. And we'll talk about that in detail as well. And it seems like there's always something going on the political stage, right? Whether it's politics here in the US, whether it's just international politics or confrontations, supply chains, et cetera. There's always uncontrollable factors. And we'll talk about some of those as well going forward. So just a reminder, if you guys have any questions as I go through these, please feel free to ask them. So high inflation. Okay, so when you see high inflation, the way that they measure inflation is through a report called the CPI, the Consumer Price Index. Right, when I did this review last quarter, we actually did it in July. We did the mid-year review, right? We saw the CPI report was over 9.1%. And at that time, that was the highest year-over-year increase since 1970. So inflation is just the cost of goods and services going up, right? And inflation is bad for the economy, hyperinflation, right? Because that means that things are becoming more and more expensive, and you're able to purchase less goods and products for the same amount of money as you were the year previous, right? So ultimately, you think about that. If you're not getting a big wage increase and inflation goes up by 10%, you're now purchasing 10% less products or less services for the same amount of money. And that's bad for business. It's bad for the economy because you can't afford as much as you did the year before, right? So when we look at it, when you look at the November report, the CPI report was up 7.1% year over year. Okay, so we're at 7.1%. So we dropped from 9.1 down to 7.1. That's the good news. Okay, but most people are saying, how did we get from really relatively no inflation the last 10 years to inflation that was almost double digits in July? Okay, and what caused it is the pandemic really sparked a large amount of stimulus being infused into the economy. Now, this is not a political thing, whether you're a Democrat or Republican, right? Both parties, had their hand in printing stimulus to help the economy through that difficult time with the pandemic. So there's a few key pieces we have to look at, right? We printed as a nation over $4 trillion, that's with a T, $4 trillion of economic aid the last roughly 2 years. 80% of that aid ended up in the hands of consumers in some capacity. So some of those stimulus programs, right? Some people receive stimulus checks, right? They have forbearance on student loans, which is still in place. We had forbearances on evictions. We had forbearances on mortgages. We had PPP loans for small business companies that were forgiven. We had the Child Tax Act, right? So if you were under a certain income threshold, you received $300 per month per child for a 6-month period at the end of last year. So, for certain individuals that qualified for this money, it put an infusion of cash into their pocket. And ultimately, the first few months they saved it, but then they got used to having it. And it changed their spending habits. So they started to spend more. So if you look at the GDP, the gross domestic product, which is a measurement for people spending in the United States, it was at 5.3% last year, right? Which is the highest since 1970. That's great. But the problem is with COVID, there was a huge disruption in supply chain. So during the pandemic, we had a lot of positions that weren't filled. A lot of people didn't either feel safe going to work or there weren't positions for them. So we were underemployed from a staffing percentage. And then in addition to that, we are a large importing company, our country. So we import a lot of our products. And as we import those, right, China is one of the main players that we import from. They have a zero COVID policy and they're not exporting at full capacity. So here we are as a nation with this huge desire, right? We've been pent up for a year and a half where really you couldn't travel, you couldn't do the things that you were normally doing. You're saying, when this pandemic's over, I'm going to go and I'm going to do those things, right? So we have the desire to spend money. We have this huge infusion of cash flow. So the average consumer has more cash now than they did pre-pandemic. And then all of a sudden we're rushing to the store, but there's no product or inventory available. So think about it. You go to the car dealership, 12 people want to buy a car, and there's one car available, right? What's the dealership going to do? It's supply and demand. If there's one car available and 12 people want it, right, it's whoever's going to pay the most. And that's what we've seen, right? The cost of that product or inventory goes up. So that's how we got to this point from inflation, okay? When we look at it ahead, right, the key takeaway that I want you guys, so those of you that are taking notes, the key takeaways are inflation is starting to come down. Okay, these are the positives. So it was at 9.1 in July, it's down to 7.1 now. When you look at the CPI report is the last 12 months. And if you look where my cursor is here on the right, you can see the biggest jumps that occurred in the inflation index were in the fourth quarter of 2021 and in the first quarter of 2022. So what that means is as those months start to fall off the CPI report, we should continue to see inflation drop fairly drastically. Okay. We saw that already in October. If you guys were watching the webinar I did in July, I said October's the key month to watch because the CPI report in October last year was up 0.9%. And anything less than 0.9% as an increase would drop the CPI report. And that's exactly what we saw. And we're going to continue to see that CPI report come down based on the factors we have right now, barring some, unforeseen circumstance, et cetera. So the big key driver that we're watching is ultimately we saw huge increases in the CPI report, fourth quarter of 2021, first quarter of 2022. And those are going to start falling off the report here every month going forward. That's great news. Okay. Also, for those of you that aren't looking to go buy a new home or aren't looking to buy a car or really just, kind of set with what you have, inflation is increasing your balance sheet. You're increasing your net worth. And a lot of retirees fall into this and they don't think about it, right? Because it's just on paper. So inflation is a driving piece that if you have assets, those assets are typically increasing in value. So think about homes, for example, right? Even home prices in 2020 when people were buying and where they are in 2022, right? As inflation goes up, right? That's the cost of goods and services increasing. If you already own those goods or services, they increase in value, right? I've been joking with clients, it's the first time since I can remember that you buy a car, drive it for a year, and it's actually worth more a year later than it was when you purchased it after driving it, right? It's kind of weird to think about that, but it's an anomaly currently. So those of you that have assets and don't have a lot of debt, inflation in the short term, we do not want prolonged inflation, right? But inflation in the short term is actually helping your balance sheet because ultimately your net worth has been increasing and you haven't had to take on any substantial debt at a higher interest rate. Okay, so just keep that in mind. So those are the three big takeaways. Inflation's coming down. We should see it continue to taper through the end of this year, the beginning of next year. And ultimately, we can increase your balance sheet thereafter, right? Leads me into my next piece, okay? High inflation leads to increasing interest rates. They go hand in hand. And most people ask the question, right? Why are interest rates rising? Or how does it make sense that interest rates go up and inflation can come down? Okay. So inflation is a sign that the economy is overheating, right? They call it a hot economy. So if inflation's high, that means that consumer spending is way up and the supply chain can't keep up with it, right? So it's a sign that the economy is overheating. The demand is higher than the product supply. So when they increase interest rates, okay, when you see the Federal Reserve step in and increase interest rates, what they're doing is they're trying to strategically cool down the economy. Okay, they're trying to strategically cool down the economy. So, for example, right, if you were to buy a home, most people that purchase homes in the United States use a mortgage, right? Or if you go to buy a car, most people take out a car loan. Okay. So when they increase interest rates, what they're doing is they're making credit or things that you purchase with credit more expensive, right? So if you're paying more interest to the bank or your mortgage company or a credit card company, etc., your monthly bill is higher to purchase that same home, same car, right? So if you're purchasing a home with a 7% mortgage rate versus a 3% mortgage rate, you're paying more interest to the bank. So your monthly payment is higher, which means you have less cash flow left over at the end of the month. So your desire to buy all those extra products or extra items comes down, and ultimately the supply chain can fill back up, right? So what the Federal Reserve is doing is they're saying the economy was overheating. We're going to strategically cool down the economy, and we're going to reduce the demand that people want to spend money by buying certain things, right? So people are going to always buy their home, they got to pay their light bill, their cars, etc. So as they do that, if more of their money is going towards that institution, they're purchasing less additional products, the supply chain fills back up. Anytime the demand is diminished and you have an overabundance of product, it's like going to the store, right? And you have just rows and rows and rows of this product that nobody wants to buy. The store is going to start to discount that, right? So they're going to start to cut the price, right? Until the demand is there and people start purchasing it again. So what they're doing is they're raising interest rates. People are paying more interest. They have less cash flow left over. As they have less cash flow left over, ultimately the supply chain is filling back up and you start to see inflation decrease. Okay, that's the supply and demand side. The making credit more expensive is when you hear interest rates are rising, right? What that means is mortgage rates are going up, right? Car loans are going up, credit card interest is going up. So the federal funds rate is what is being increased. And the federal funds rate is the rate in which the Federal Reserve is loaning money to banks or institutions. So if banks or institutions have to pay more interest to get that money from the Federal Reserve, they in turn are charging you more interest as the consumer because that's how they make the profit. So the last bullet point that you see on here is you really have to pay attention to what you're investing in. You should do this all the time, but right now it is exponentially important. So for example, we have been in a rising interest rate environment, particularly the last 6 to 7 months. Okay. And as interest rates go up, if my arm's a teeter-totter, as interest rates rise, bond prices will fall and they'll fall quickly. So traditionally, and I say this, right? Traditionally, when the market gets volatile like it's been, right? Economists will talk about selling stocks and buying bonds, right? Because bonds traditionally are more conservative than stocks or equities. Okay. But we are not in a traditional market. So right now, as interest rates have risen, we've seen other people out there, oh, we got to get into bonds. Well, if you're getting into bonds, you're literally guaranteeing yourself to lose money, right? And that's not good for anybody. So just remember, as interest rates rise, bond prices fall. We have to be aware of that, and we have to pay attention to it going forward, okay? So key takeaways that I want you to have, right? Higher interest rates have now created opportunities that we haven't seen in 15 years. This can be a good thing. Okay. So there's low risk investments out there that are really starting to show some attractive yields. So what I mean by that is we're seeing things that have zero risk, paying 3.5%, 4.5%, even close to 5% now. Okay. So ultimately low risk investments are starting to really pay some very attractive yields. This is important for people that are retired. They're saying, you know what, I don't want a lot of risk, but I want to be able to harvest some form of income off my investments, right? There's opportunities we haven't had in the past that are now coming to fruition, which is great, right? You now have the ability to start reducing your risk exposure for the future. Interest rates are not going to go up forever. They're not, right? So we have this blip of time where interest rates are elevated that, if you're not having the conversation we need to, where we have to look at saying, okay, how can we lock in some of these more attractive rates for the foreseeable future, knowing that rates are probably going to be cut or go down at some point in the future. Okay, so we have this opportunity here. So just be aware of that. If you're not having that conversation, we need to start having that conversation. Okay, those are the 3 takeaways for interest rates. Next one is world unrest. I left this with one slide, literally one slide. So world unrest, I have a picture of Russia and Ukraine up here. You think of the, zero COVID policy with China. You think of the oil issues we've been dealing with, right? We've tapped the strategic oil reserves multiple times over the last 12 months to keep gas prices in check, right? You look at energy costs and how they've increased here, over the past 12 months because of some of the, unrest that's out there. You look at the possible food shortages that are in place because of war and conflict. There's all these things, okay? We can control none of them. Just remember that. We have zero control over any of those events. We do not want to react to events we can't control, but ultimately we want to be prepared for all the various what ifs, right? So that's where you have a conversation around what your goals are, what you're looking for, what your time horizon is, and then how do you achieve that without taking an unnecessary amount of risk and exposing yourself to all of these different events that could happen, right? If we spent all of our time worrying about things we can't control, none of us would have any time left in the day and we wouldn't sleep at night, right? So just remember, you have no control over any of these items and you want to plan and prepare ahead of time so you're not being reactive, selling when you shouldn't sell, taking distributions from something you shouldn't be taking distributions from, etc. Okay, so that's the only piece that I'm going to touch on with your world unrest side, because there's always going to be the next. There's always going to be something that's occurring out there. All right, opportunities. This is really where I want to spend a lot of our time, right? Is going through opportunities. So there's 4 bullet points on here. I could do an entire webinar, right? And maybe that's something, Jenna, if you're jotting down notes here, we look at in the future is even doing just webinars on each of these to go more into detail to really do them justice. Okay, so the first one that I'm going to talk about is what's called tax loss harvesting. So if you're taking notes, I really want you to jot this down because this is extremely timely because it's the 16th of December today. And you would have to place trades before December 31st in order to take advantage of this. Okay, so tax loss harvesting is for people, it's not for everyone, but people that have an after-tax account. So when I say after-tax, that would be an account that's not an IRA, that's not a 401k or a 403b. So not pre-tax, but maybe money that you had saved over the years and put into an investment account. They call that an after-tax account. And on your statement, you probably notice there's a spot that says like unrealized gains or realized gains. Okay. So the last 5 years in the market has done exceptionally well, right? We've had a really nice increase in the market over the last 5 years. And there's probably some holdings that have done exceptionally well also. But what happens is when you see the market go on a run like that, those more aggressive holdings that have done very well, right, that go up very quickly, also fall very quickly. And they start to become a larger percentage of your portfolio because you've had substantial gains over the past 5 years in this example. So I met with a client actually just yesterday and went through this strategy. So I'm going to share their story with you. So in hopes of explaining it in a very simplistic way. So the client came to me 2 years ago, and they were in some investments that have done exceptionally well. They're in their late 70s, and the investments they were in were way too aggressive for what their goals were. Okay. But they had done exponentially well because the market had performed exponentially well. They don't see themselves needing the money, but they also are at a point that if they wanted to sell those holdings because they had such substantial gains in the account, they would have paid Uncle Sam a lot of money through what's called a capital gain. Okay. So capital gains, there's long-term capital gains. That's something you've held for more than 1 year and 1 day. And then there's what's called short-term capital gains. And that's just something that's occurred within the last 12 months or less. Okay. They're taxed differently. We'll go through that in the future. The opportunity that came up was ultimately all of these aggressive holdings that were way up the last 5 years, right? Now they're slightly down. Okay. The market's been down, they're slightly down, but they still have a substantial gain. Some of the other holdings that had not performed well, right, during that time period are at a loss currently. The advantage that you have is if you have something that is trading at a loss and you have something that is trading at a gain, they can offset each other. So the reason I say this is an opportunity is right now, if you can think of any large distributions that you're going to need in the next 12-month time period. Okay. So something you might need in the first quarter or June of next year, you know, you're going to need to purchase a car, let's say, for example. Okay. So for this client, they did want to buy a car and they needed about $50,000 in June. They ordered a vehicle. Okay. So for them, if we went in and just sold that holding that had that substantial gain, they would have owed Uncle Sam about roughly $15,000 in taxes doing that. So what we can do is we can look at anything that has a loss, sell the asset at a loss, and then also sell the asset at a gain to offset the taxes. And it frees up the cash flow for them where they no longer owe Uncle Sam anything because it's a wash, right? They had a loss, they had a gain, it equaled the same amount, and they were able to take the distribution without incurring any type of gain that needed to be reported to Uncle Sam. So tax loss harvesting is a strategy that doesn't always come around. It does not always make sense, but for certain clients right now, absolutely it does make sense, and it's something worth looking at. Okay. If you have any questions about that specifically, we can go through it in detail together. And we could actually probably do a whole other webinar just on tax loss harvesting. The next piece is Roth conversions. Okay. Many of you probably know what a Roth IRA is or have heard of it in some capacity. The advantage of a Roth IRA is the money that you put in, you've already paid taxes on, and it grows 100% tax-free going forward. All right. That's extremely powerful. So there's two different pieces. There's what's called a Roth contribution, and then there's what's called a Roth conversion. A contribution, if you're retired and no longer working, you can't contribute to a Roth unless you have earned income. Okay. And you can only contribute to a Roth if you're under a certain income as well. There's different rules and restrictions that apply to that. But a Roth conversion can be very advantageous for people, especially if your goal is to leave money behind for loved ones. We do full webinars just on this, but ultimately with a Roth conversion, if the market is down, right? So you have to ask yourself, if the market's down 20%, do you feel that it's going to grow in the future? And the answer should be yes, right? It should be higher in the future than it is today, right? Are we going to see volatility? Absolutely. But if you're investing for the long term, you would rather do a conversion when the market is down, because as the market recovers, if you moved the money from an IRA, paid some tax on it, put it into a Roth, all of the gains as the market recovers are 100% tax-free versus waiting in the IRA, letting it accruing, and then basically paying taxes on a larger amount of money. So right now, Roth conversions are something we're going through with many, many clients, because as the market's down over time, right, as it recovers, all of their gains would be 100% tax-free, and they'll have a bigger asset amount in the Roth, growing tax-free for their kids, their loved ones, and themselves in the future. So Roth conversions is a great conversation to be having here in the short term. Okay. Reallocating for the future. If you're in an after-tax account, like we talked about, tax loss harvesting can be a great strategy to say, hey, some of these holdings were too aggressive for me, but we did really well the last 5 years. We didn't want to pay taxes on them. Now we have the opportunity to harvest something at a loss and something at a gain, and we freed up this cash. Now let's reallocate that, look at it and say, okay, how do we take advantage of the future? Because the markets are always adjusting and changing, right? Ultimately, it's really fun to see the accounts go up. It's really fun, right? But the pain that comes with the market dipping, and if you're in something that's too aggressive for your risk tolerance, it hurts that much more, right? I've sat with clients where they're like, oh, this went up. It went up, up, up. This was great. And now they're down even further than where they started because they were in something that was way too aggressive for their holdings, right? And now that's why they're introduced to myself as we're saying, how can we adjust this in the future to not go through that pain, but hit your goals in a better way where you're not taking so much risk, but still capturing the upside, right? So this is a great opportunity to have that conversation. Same thing, if you're in bonds in a portfolio, you need to be having that conversation. If you are in a 401k, right, and you're in a target-based mutual fund. So what I mean by that is when you allocate your 401k, you can choose like the 2020 lifetime fund or the 2025 fund. And what that is the closer you get to that year, the more conservative they're making the investments. What that means is they're selling stocks and they're buying bonds. When interest rates go up, you do not want to be in bonds, right? So it's happening automatically in the background and people don't even know that it's happening. So that's where you need to be paying attention to reallocating those assets for the future. And then the fourth one is we have an opportunity for additional contributions, right? As the market dips, right? If the market's down 20% and you know that you want to invest for the long term, you would rather buy at a 20% discount than buy it where it was. And we hear this all the time. It's human nature, right? The market's down. I don't want to add. I'll wait till it goes up. No, if you're going to add, you add when it's down. It's like going to a grocery store, right? And something's 20% off, right? You're able to buy 20% more for the same amount of money. That's the advantageous spot, right? So Warren Buffett, who's one of the best investors ever, right, says be fearful when others are greedy and be greedy when others are fearful. So when the market looks gloom and doom and the market's down, that's when you want to be greedy. That's when you go in and you start making your purchases. Many of you have continued to do that through your 401ks, through contributions for Roth, through after-tax contributions. Just don't lose sight of that, right? I know at times it can feel like you're spinning your wheels, but as the market recovers, that's where your gains come from being strategic with your purchases. All right, looking ahead, right? Three pieces that we have, okay? Inflation is starting to ease. We have seen it come down. Is it still high? Yes. Right? But is it coming down? Yes. Do I anticipate it continuing to come down? Yes. So interest rates are increasing, but they're starting to slow. So the three previous Federal Reserve meetings, they increased the interest rate by 0.75% each meeting. That's the fastest increase in US history. Okay. This last meeting, which was on the 14th, so 2 days ago, they increased it by 50 basis points, or what they call 0.5%. So they're starting to increase, or they're continuing to increase, but they are going at a slower pace. And we're anticipating that most likely we would see those continue to slow on the increases. They're eventually going to get to what they call neutral, right? They're cutting rates. They're strategically slowing down the economy. They're going to get to a point where they say, okay, this is where we can either raise interest rates or cut interest rates in the future. And that typically is where we start to spark a recovery off of that number. So just pay attention to that. Interest rates are starting to slow on their increases, okay? There's still a lot of uncertainty out there, right? There's uncertainty with the markets. There's uncertainty with inflation. There's uncertainty with the political side in the US. There's uncertainty, just on the geopolitical international scale, all those things. Just be aware with that. And honestly, you just got to be okay with it. Just be at peace that you're in good companies and there's always going to be something that's occurring during those times. So how to be successful, Literally, this is the same slide that I had during our July review. Okay. And the reason I wanted to put it up here is because it's timeless, right? You want to focus on companies that produce products that you need regardless of the state of the economy or the cost of that product. So I'll use toilet paper as an example, right? Regardless of the market volatility, you still need toilet paper, right? If you don't, that's a different conversation. But we learned during the pandemic, people go crazy for toilet paper. But in addition to that, if a pack of toilet paper goes up $1, you're still going to pay the increase, right? If your light bill goes up $20 a month, it stings a little bit. You might turn more lights off in rooms when you leave, but you're still going to pay it, right? Same thing with your gas bill. Same thing with buying food, right? Food prices are up. You might buy some off brands, but ultimately you're still buying food because you need those items. That's a great way to insulate yourself from volatility. Many of the clients that are on this webinar right now, right, the market's down 18%. I've been doing meetings with those clients. They're down anywhere from maybe 3 to 4%. It's an extreme way of being insulated from the volatility, but still capturing the long-term upside, because as the market recovers, you still continue to see the long-term growth, and ultimately you're growing on a bigger number, and that's where the gains come from. Know what you're invested in and make sure you're properly positioned going forward. As we talked about, with interest rates being higher, there's some opportunities to look at positioning assets for the short term here to reduce the risk, but also capture some really attractive yields, right? Some interest in your pocket. And then in addition to that, positioning yourself that says, am I going to touch this money in the next 2 to 3 years? If the answer is no, how do we want to position it for the future to continue to capitalize on growth with the market being down? Focus on the longer term and not the now, right? You'll drive yourself crazy focusing on the now and just saying all the what ifs. Continue to focus long term, right? Especially if you're not spending the money right now. You plan for the now and you plan for the future. We don't want to react to the now. Okay. What we're doing is we have a plan that's in place that says this is how we're positioning things currently that fits into the future, and they need to work together, right? Continue to dollar cost average into accounts. So if you're working and you're adding to a 401k, keep doing it, right? Keep doing it. And I know it can be really frustrating because when the market's down, right? So for example, if you have a $400,000 account and you're contributing, let's say you're under the age of 50 and you have 400,000 in your 401k, right? The most you can contribute is $20,500, not including your company match. That's the maximum contribution you can make this year. Well, if the market's down 10%, let's say, or your account's down 10%, and you have a $400,000 account, well, you're down 40,000 now. You just put 20,000 in, and it feels like you got nowhere, right? And that's what's frustrating is you put in $20,000, but you're still less than what you started with. Don't stop, because when the company or the stocks or holdings that you're in recover, and let's say the market's up 10%, you put in $20,000 in that example with the market being lower. Not only are you getting the recovery out of what you invested in, also in addition to that, the money that you put in during that time is growing at that same pace. And that's where you see exponential growth, right? Wealth is not a straight line. Wealth is a hockey stick. You chug along, you chug along, you chug along, and all of a sudden it takes off and goes up exponentially, right? You'll get to a tipping point that the money that you contribute is less than the gains when the market's up. And that's where the more, right? They use the term the rich get richer and so forth. They get to that hockey stick point, and ultimately the wealth becomes exponential. And then insulate yourself, right? Know what you're invested in, right? There's companies out there that you have to have regardless of what's occurring in the marketplace. And you have to buy their product regardless of what the cost is. That's what, especially if you're taking income, that's what you want to focus on, right? How am I going to get paid without having to harvest principal? How do we look at companies that continue to increase their dividend or income potential every year, and we don't have to harvest principal? And then you have to look at where am I going to take my income from now, and where's my growth going to come from in the future? Because inflation's not gone, right? There'll be inflation in the future as well. So that's the bulk of the presentation. What I'd like to do now is I can see there's quite a few questions that are coming in on the bottom. So I want to take and set aside a good amount of time here And Jen, I apologize. I got a little long-winded there. I went a little longer than I anticipated. Sorry to
That's
everybody.
okay.
But I do want to go through these questions in detail. And if you have other questions, please ask them as we go through. So I'm going to stop sharing here and we'll go through some Q&A.
Okay, awesome. So Tyler, one of the many asked questions that we had privately and openly was, will you automatically adjust our portfolios based on these new opportunities that are coming to fruition?
Yeah, absolutely. So absolutely. So as a team, we have an investment committee. There's 7 of us on that committee that are watching all these trends. And quite frankly, they're extremely smart when it comes to market analytics, and they're the ones bringing a lot of these statistics to the forefront that I'm going through with you. As we sit down and go through there, we're making adjustments inside the portfolio for market conditions. Where I use that statement with making sure that we're paying attention to these different opportunities, that's a client by client type scenario as we go through, right? So there's certain clients, let's say, that really just love to hold cash, right? Well, they might be holding cash, and a conversation I have with a lot of them is just, where are you holding the cash at? Right? If you're
Mhm.
holding the cash in a checking or savings account, most local banks are paying right now maybe 0.25% from a savings account standpoint. Well,
Okay.
even outside of us right now, Jenna, you can see money markets that are paying 3.5 to 4% with no risk and they're FDIC insured. Well, we
Hmm.
just we just got them a 300-400% return on their cash savings with no risk by just literally utilizing a higher yielding account that they weren't aware of. So it's
Right.
it's it's case by case, but yes, from the portfolio standpoint of what we're overseeing, absolutely we're making those adjustments already.
Awesome. This was a question that was asked during the tax loss harvesting section that commented, would annuities also be good in this situation too?
No, so the annuities are different. So annuities are what are called, like if you have an after-tax annuity, that's called a
Okay.
non-qualified account. And most people get confused. They're like, what does non-qualified mean? It just means it's not an IRA, but it still has qualifications. So qualifications, qualified plan equals IRA. So non-qualified, an annuity, if you take distributions from an annuity, they're taxed at ordinary income, not capital gains. So because it is a tax deferred vehicle, tax loss harvesting is not able to be done with an annuity.
Okay. Okay. I hope I answered that question. If not, whoever asked the question, please follow up with us afterwards to get more clarity on that.
Right.
Here's another one as well. So many articles recently claiming that inflation cannot normalize, nor a market bottom can be claimed without a recession. What are the implications of current and future investing? What do we need to look out for?
That's a loaded question. That's a good one. So a few different factors. Inflation is high, and what the Federal Reserve is doing, right? So interest rates typically, even during inflation being this high, would not increase this rapidly. Number one, in Powell even admitted this during his last presentation, they waited too long to act. So they were
Mm,
behind the 8 ball and they had to act very quickly to get ahead of inflation with interest rates. That's number one. Number two is we're still at a labor shortage.
hmm.
So when you increase interest rate, what the Federal Reserve is actually waiting for right now is they want unemployment numbers to go up. And it sounds so backwards. And the reason they want unemployment to increase is they know that if people are, or more people are unemployed, wage increases will go down. So what's happening right now is because we're at a labor shortage, meaning that there's a lot of job openings available. Ultimately,
Hmm.
what's occurring as wage increases continue to go up. So if you're seeing a wage increase of 10% and inflation's at 7%, people continue to spend because they got a raise that was higher than the cost of living adjustment.
Right.
So when the Federal Reserve is increasing interest rates, they're behind the 8 ball, number one, on starting. And now, number two, right, wage increases continue to rise. So
Hmm.
that R word, that recession word that you hear all the time. I
Hmm.
mean, realistically, no one ever knows when or how or if we'll go into recession. The
Right.
the the major piece that we have to pay attention to is if you're planning ahead of time, would you do anything different in a recession than you're doing right now? And for the majority of our clients, the absolute answer is absolutely no. right? You're still holding the good,
Mhm.
solid companies that you're not going to sell regardless. You're still getting really good dividends that are going
Mhm.
up each year because of what you're invested in. And you're insulating yourself because of the sectors and the way that you're weighted in those portfolios. So as long as you're prepared going through it, don't let the recession scare you. That's an opportunity for the future that says, how do I utilize some of this to grow if that does occur? A recession by definition is just 2 negative quarters of GDP growth. That doesn't mean that it's going to be some catastrophic sell-off or some kind of crazy
Mhm.
volatility. And the market is typically pricing in volatility 6 months in advance. And we're already down about 20% year to date. So, I mean, we're seeing a lot of that volatility probably being priced in for any economic factors regardless. But we just have to be prepared. And I hope I gave enough detail on that question. Um, but if not, I'm glad to follow up with whoever that was as well.
Awesome. Yeah, I've made sure to keep track of these as well. I have another question. This was earlier in the conversation, or excuse me, your presentation is when you were talking about bonds. Do you trade our bonds for better opportunities essentially automatically for clients? Do you utilize bonds in that situation?
Yeah, I mean, the majority of bonds that we held in the portfolios, we made adjustments already last year, anticipating that inflation would rise. So there's different types of bonds out there, and there is a place for bonds in portfolios. So I'm not blanket stating saying every bond is bad, right? So when I showed that teeter totter, that interest rates rise and bond prices fall, there's three typical classifications of bonds, right? There's long-term bonds. If interest rates rise, those fall exponentially. There's
Mhm.
intermediate term bonds, which would fall a little. And then there's short
Mhm.
term bonds, or what they call short duration bonds. Well, if you have
Mhm.
a duration of 3 months, right, you see very little or no volatility because people will hold them to maturity, right? Same
Right.
thing with treasuries, same thing with those conversations. So, yes, we do pay very close attention to those, and we are making adjustments inside of there as we see necessary.
Okay. Awesome. I have another question that says, what about putting some extra cash into short-term investments such as CDs? They're paying pretty well right now. Then you can
Mm-hmm.
stay a little bit more liquid.
I like it, but you got to buy the right CD, and you have to look at basically your goals with the money. So if your goals with the money, like what I've been telling clients, is if you're not going to touch the money for 10 years, right? Going into a CD that's going to pay interest for 4 months or 5 months isn't going to achieve that goal for you, right?
Okay.
But
Mhm.
if you see yourself needing those proceeds or possibly needing those proceeds in the next year, 2 years, 3 years, or you have a big expense coming up, yeah, I absolutely love that. Right. We're seeing CD rates 4.5% in certain circumstances. And it's a case by case thing, but absolutely locking in some of that. If you have cash on the sidelines, that's a great way to get some of that additional protection, but at a higher interest rate than like a savings account would be.
Okay. Awesome. I love that. All right. So I have a couple more questions. One of these questions asked, this was near the end. It said, will my taxes go down since I lost so much money this year?
That's a great question. Um, but not necessarily, right? So ultimately what I mean by that is, there's a webinar and a seminar we do called a mutual fund tax trap. And
Mhm.
for after tax money, I dislike mutual funds and after tax money very much, right? So the reason I dislike it is there's an internal money manager with a mutual fund that will buy and sell, and their job is to get the highest return out of that mutual fund. Well, in a down market, it's pretty hard to get a high return, period, but they're
Mhm.
still buying and selling. And the problem with
Right.
a mutual fund is you could have put 100,000 into an investment, have it worth, let's say, you know, 90,000 at the end of 12 months, and
Hmm.
then ultimately get a 1099 that you had a capital gain because they sold something they've held for 3 years, right? And it was up. So depending on your investments, depends on if you will have any capital gains or capital losses. If you're holding equities, directly, you shouldn't be seeing much for capital gains unless you
Okay.
harvested them or did a rebalance of a portfolio, something like that. So yeah,
Okay.
there shouldn't be near as much taxation there, but
Okay.
we can't say that it won't be.
Fair. I understand that. Okay. So this question was actually asked a little bit earlier in the presentation, but I wanted to wait till the end to ask it because I feel it's kind of a loaded question for you, who is very intelligent about all of this. It said, we knew there was a problem with supply chain demand in the summer of 2020. Okay. Why? did the government wait until 2022? They knew printing so much money would play into this. Was there anything better the government, could have done earlier or differently?
I mean, looking back, hindsight's always 2020. The issue with the pandemic is no one knew how long it would last. No one knew the severity of it, and no one knew the impact because we haven't dealt with one like this ever. Right. So, you think of the last type of pandemic, the Spanish flu and so forth. I mean, that's 1918. That's 100 years ago. Right. And technology is different. Business is different than that time.
Absolutely.
So ultimately, yeah, looking back, absolutely, they wouldn't have printed so much money. Right. I mean, they whether, like I said, I mean, it started with the Trump administration, it continued with the Biden administration. There was no true metric to gauge because what their goal was is people need the money. Certain people, not all people, but certain people need the money right now. And we got to get it in their hand right now to avoid that cliff. Because you remember in the March of 2020, the market fell 39% in 3.5 weeks. Right now, it recovered rapidly. And the reason it recovered so quickly is they put money in the hands of consumers. Looking back, if they could do it again, I am quite certain that they would have tapered or slowed that flow and not continued to print continued money after continued money after continued money going forward, because that's what drove inflation higher. So the problem is all of that's a lagging indicator, meaning you don't know how much is enough or too much till after it's done. And they just kept going, kept going, kept going. And then also, once you start that faucet and you start giving people money, it's really difficult as a politician to turn that off if you want to get reelected. So there's a whole lot that goes into that. But yeah, I think if they could do it again, I think they would have done it differently. At least I hope. And they wouldn't have infused quite so much economic aid.
That's fair. That's fair. All right. So I have one more question. It says, I am thrilled that you automatically trade for us. I did receive an email about this. Are clients supposed to give their opinion on those trades?
I mean, they absolutely can. I mean, when we're doing it, we're not basically when you're having us actively manage an account, what we're doing is we're saying, hey, this is the risk profile that we need to stay within based on the conversations we have. And we're acting in a fiduciary standpoint to say, hey, we want the account to continue to be protected and increase, right? So we don't charge anything to buy or sell. There's no commissions attached to any of those, trades and so forth that are there. The reason we're doing it is, number one, we want to protect the account. And number two, we want it to continue to exponentially grow over time. So as we make those adjustments, it's for your best interest. But yeah, if you had a company you're like, I really love this company, or I used to work for this company, I have a soft spot for them, and I want to also have some in there. Absolutely, we want your input on those. But as we're sitting there with a group, we're vetting out what are the best companies and why, and we're doing all that back end research, and we have the capabilities and software and team to do so. So yeah, we're doing it for the best interest of the client, but we're always open to have those conversations.
Awesome. Well, that's all we have for today. If anyone has any further questions, please feel free to email us. We're happy to reach out with a 10 or 15-minute phone call or response to an email. Is a great way to stay in great communication. So thank you so much, everyone. And Tyler, do you have any further words?
No, I just want to wish everybody a happy holidays and a Merry Christmas here as we go into this season. We really appreciate all of you. If you have any questions, please feel free to reach out. If you need help with anything, please feel free to reach out to our team. That's what we're here for. And hope everybody has just a great rest of your day.
Thank you.